Well, we talk a lot about cash today at GE, rest assured. Clearly, the aviation business that generated more than $4 billion of free cash in 2019 is a key part of our cash story.
What is up, guys? My name is Ignas. Welcome back to the channel. Last week, General Electric reported quarterly earnings, and they have year-over-year growth in all four segments. But it seems that everyone is most excited for their aviation part. Larry Culp, the CEO of GE, went on CNBC to discuss their view. This is what he had to say.
What we look at every morning are departures around the world by region, by engine platform. And what we've seen for several months here is the U.S. Recovering. You heard from all of our airline CEO customers just last week relative to those trends. We see Europe slowly, gradually coming back here of late as well. China is just off single digits from where they were in 2019. So the key markets for us around the world are improving. We see that knock-on effect in our shop visit activity, which is really the core work that we do in our aviation services business. We saw shop visits improve sequentially in the second quarter compared to the first, and we think we'll see continued sequential improvement into the back half. Clearly, lots of things that we all have our eyes on, including the Delta variant. But that said, it looks like the leisure traveler is back, and business travelers are not that far behind, hopefully. I think on balance, that's what gives us the optimism and the confidence about our aviation business.
So demand for flying is coming back in different markets, and in turn that is a huge benefactor for their service business. So for today's comparison, I have picked the largest conglomerates from the specialty machinery industry. The names are General Electric, ticker symbol GE, Honeywell, HON, and 3M, ticker MMM. In order to make the comparison possible, we will be looking into 8 different factors: analysts' price targets, forward price to earnings ratio, annual revenue growth, price to sales ratio, return on equity, last 4 quarterly earnings results, current ratio, and dividend yield. The best company under each factor will get a point, so it is possible to have from 0 to 8 points, and in the end the stock with the most points will be considered the winner of this comparison. I hope that the rules were clear, and early thumbs up would be much appreciated, and with that out of the way, let's begin. The first factor we are taking a look at are the analysts' price targets. As investors, we want to check how far the current share price is away from the average analyst target. If the current price is under the average target, we will consider the stock as undervalued, and in the end, a company with share prices furthest away from the average analyst target to the lower side gets a point for this factor. For General Electric, we have 15 price targets of analysts. They range from the lows of $10 to the highs of $18 per share. The average is at $14.97, and the current share price is at $101.02, which adjusted for the reverse split will be at $12.63 per share. This means that there would be around 18.5% room for the current price to reach the average target of analysts. For Honeywell, we have 20 price targets of analysts. They range from the lows of $200 to the highs of $270 per share. The average is at $237.99, and the current share price is at $234.21. This means that the current price needs to go up for 1.6% to reach the average target of analysts. For 3M, we have 17 price targets of analysts. They range from the lows of $134 to the highs of $218 per share. The average is at $196.65, and the current share price is at $198.38. This means that the current price is already 0.9% over the average target of analysts. Results for the analysts' price targets factor are in the table, and with most room for growth, General Electric gets the first point. Second factor is the forward price to earnings ratio. It is calculated by taking the current share price and dividing it by the estimated future earnings per share. This is the standard price to earnings calculation, with the difference that earnings here are predicted by analysts. So in the end, the stock with the lowest forward price to earnings ratio gets a point for this factor. General Electric has a forward price to earnings at 194.27. Forward price to earnings for Honeywell is at 25.71. and 3M has a forward price earnings at 18.77. Forward price earnings ratios are in the table, and with the lowest value, 3M gets the first point. Third factor is the annual revenue growth. As investors, we want to find that the revenues of a company are on a steady increase. We will take a look into the 4 most recent years and compare them one by one. If revenue was on the increase from one year to the next, we will consider it as a +1, and if it was on the decrease, it will be a +0. Then we sum the results up to a minimum of 0 and a maximum of 3, and in the end, the stock with the highest sum gets a point for this factor. We have annual revenues for General Electric, and going into 2018, there was a decrease to $97 billion US. Then into 2019, we had another decrease to $95 billion, and going into 2020, there was another decrease to $79.62 billion. So with 3 decreases in annual revenues, we get a sum of 0. Annual revenues for Honeywell, and going into 2018, there was an increase to $41 billion US. Then into 2019, we had a decrease to $36 billion, and into 2020, there was another decrease to $32.6 billion. So with 1 increase and 2 decreases in annual revenues, we get a sum of 1. Annual revenues for 3M, and going into 2018, there was an increase to $32.77 billion US. Then into 2019 we had a decrease to $32.14 billion, and going into 2020 there was an increase to $32.18 billion US. So with 2 increases and 1 decrease in annual revenues, we get a sum of 2. Results for the annual revenue growth factor are in the table, and with a sum of 2, 3M gets another point. Fourth factor is the price to sales ratio. It is calculated by taking the company's market cap and dividing it by the trailing 12 months worth of sales. The formula suggests to be looking for a company with a low market cap and a high result in sales. So in the end, the stock with the lowest price to sales ratio gets a point for this factor. General Electric has a price to sales at 1.41. Price to sales for Honeywell is at 4.76. And 3M has a price to sales at 3.3. Price to sales ratios are in the table, and with the lowest value, General Electric gets another point. Fifth factor is return on equity. It is calculated by taking the net income and dividing it by the shareholders' equity. A high ROE shows that the company is well managed and that money from investors are efficiently handled. So in the end, the stock with the highest return on equity percentage gets a point for this factor. General Electric has a return on equity at 0.23%. Return on equity for Honeywell is at 27.64%, and 3M has a return on equity at 46.61%. Return on equity percentages are in the table, and with the highest value, 3M gets 1 more point. Sixth factor are the last 4 quarterly earnings results. When a company reports earnings, they are compared to expectations of analysts. So earnings can either beat expectations, meet them, or miss them. We will consider that beating expectations is a +1, meeting +0.5, and missing 0. Then we sum the results up to a minimum of 0 and a maximum of 4, and in the end, the stock with the highest sum gets a point for this factor. We have quarterly earnings for General Electric, and Q2 of 2020 missed expectations, Q3 beat, Q4 missed expectations, and Q1 of 2021 beat. So with 2 beats and 2 misses in quarterly earnings, we get a sum of 2. Quarterly earnings for Honeywell, and Q2 of 2020 beat expectations, Q3 beat, Q4 beat expectations, and Q1 of 2021 beat. So with 4 beats in quarterly earnings, we get a sum of 4. Quarterly earnings for 3M, and Q2 of 2020 missed expectations, Q3 beat, Q4 beat expectations, and Q1 of 2021 beat. So with 3 beats and 1 miss in quarterly earnings, we get a sum of 3. Results for the last 4 quarterly earnings factor are in the table, and with a sum of 4, Honeywell gets the first point. Seventh factor is the current ratio. It is calculated by taking the current assets and dividing them by the current liabilities. As investors, we want to find that the company is able to cover its debts with assets, but also that they are actually being leveraged. So in the end, the stock with the highest current ratio under 3 gets a point for this factor. General Electric has a current ratio at 1.81. Current ratio for Honeywell is at 1.41, and 3M has a current ratio at 1.73. Current ratios are in the table, and with the highest value under 3, General Electric gets another point. The last factor we're taking into account is the dividend yield. It is calculated by taking the annual dividend per share and dividing it by the share price. A high yield may suggest that profits are being shared with shareholders, and that is a great passive income source that we as investors are looking for. So in the end, the stock with the highest dividend yield percentage gets a point for this factor. General Electric is paying an annual dividend of 4 cents per share, which is a yield of 0.31%. The annual dividend per share for Honeywell is $3.72, which is a yield of 1.59%. And 3M pays an annual dividend of $5.92 per share, which is a yield of 2.99%. Dividend yields are in the table, and with the highest percentage, another point goes to 3M. We can calculate the results, so General Electric has 3 points, Honeywell 1, and 3M 4. This means that with 4 points, 3M is considered the winner of this comparison. And that was it. If you got value or new ideas, then make sure to push the thumbs up, it helps the channel a lot. Now there's a question for you, are you buying into any of these industrials names? Share your best pick in a comment below. If you're interested to know exactly when I buy or sell any stock, then consider the options on Patreon. By becoming a patron, you will get access to Discord, where I share all my buys and sells exactly when I do them. This could be a great option to track my moves closely. Last week we did a stock comparison on the 3 largest airline names, with Southwest, Delta and Ryanair, and we also updated our stock watchlist for trading on eToro. If you are interested in any of these, then click on a video currently on the screen. And that was it from my side, thank you for watching and I'll be seeing you all in the next one.